Today, we are focusing on building our portfolio. It's easy to design a perfect investment strategy in theory. However, the real challenge is building a portfolio you can actually stick with when things get volatile. Over this session, we will look at how to balance strategic mechanics with market psychology, ensuring your investment can survive market cycle, media noise, and your own emotion instincts. This slide bridge the gap between academic theory and real-world executions. Textbook teach us why we diversify and how risk maps to return. But theories don't manage your emotions when markets dive. In practice, success comes down to concrete choice, setting a stock to bond ratio you can defend, automating your investment, and establishing fixed rules for rebalancing. We aren't just building a theoretical model, we are building an execution plan that protects you from your own impulse. See in the left side, we have the theoretical, and in the right side, we have the practice. In the theoretical, we see diversification, risk and return trade, the efficient frontiers, the mean reversion. But in the practical side, how much in the stock with bonds, when to rebalance, how to behave in a downturn, how much to automate this. Let's continue. Now we reach the core decision of asset allocation, balancing stock and bonds. Think of stock as your portfolio growth engine. They drive long-term wealth but come with a bumpy ride. Think of bonds as your stabilizer. They offer steady income and cushion the impact when stock drop. The takeaway here is that you don't choose one over the others. Your job is to set the specific ratio between them that match your financial goal and your tolerance for a risk. See the equity. Higher long-term expected return paired with higher short-term volatility. Best treat to money you won't need for several years. And a fixed income lending stabilizer. Lower long-term expected return with steadier income and smaller swing. Caution the portfolio when equities fall. How do we actually apply this? Our asset allocation should change as your life stage change. A classic rule of thumb is to hold a bond percentage that roughly equal your age. In your 20s and 30s, you have a long-term horizon, so you can afford a 90 and 10 mix focus heavily on a growth. By our 40 and 50, competing goals require a more balanced 70-30 approach. And finally, at age 60 and beyond, the focus shifts to preserving what you have built because you have less time to recover from a market downturn. Your portfolio should always mirror your life timeline. This chart shows why a long-term time horizon is your best defense against market volatility. If you invest in a stock for just 1 year, it is a roll of the dice. You could gain 52% or lose 37%. But look what happened as we extend the holding period over 5 years and 10 years. The gap between the best and the worst outcome narrows sharply. By the time you reach a 20 years window, even the historical worst case scenario yield a positive 4% annualized return. The takeaway is clear. Time smooth the ride and take the risk of permanent loss off the table. We can design the most perfect asset allocation model, but it will still fail if your behavior overrides the blueprint when a market gets chaotic. This slide highlights the four psychological traps that derail investors. We experience lose aversion where the pain of losing money makes us sell at the worst absolute time. We file for herd mentality, chasing helped assets after they have already spiked. We suffer from overconfidence in our ability to time the market, and the recency bias trick us into a belief current trend will never end. Recognizing this bias is our first line of defensive. The bias that derive a good plan. Lose aversion, overconfidence, herd mentality, and recency bias. To tie everything together, we need to concrete checklist to bring this strategy to life. It starts by defining your specific goal and matching them to a target allocation. Next, remove our emission entirely by automating your monthly contribution. Protect your portfolio over time by rebalancing on a fixed calendar schedule, not in a reaction to a scary new headline. Finally, ignore the daily market noise by turning your investing into a structured system rather than a series of daily chores. You guarantee your plan survive the long haul. To leave you with a final thoughts, strategy set your plan, but psychology determine whether you actually keep it. Remember these three P's. First, look in asset allocation that fit your specific life stage. Second, let time do the heavy lifting. Focus on the years, not day. And finally, remember that discipline always wins. A simple plan that you follow consistently throughout a market downturn will always beat a perfect complex strategy that you abandon when the things get tough. Thank you all for your time, and I'm happy to take a question from you. See you soon.